A $60,000 pension can cut the portfolio needed to produce $70,000 of annual retirement income from $1,750,000 to $250,000. Under a controlled 30-year illustration using 5% growth after inflation, a person earning $100,000 would need to save roughly 26% of salary to reach the larger target, but about 3.8% to reach the smaller one. And at a 4% withdrawal rate, a $30,000 annual pension removes exactly $750,000 from the portfolio you would otherwise need. Those are illustrations, not universal prescriptions. They assume no starting balance, no employer match, a 30-year accumulation period, and returns that arrive neatly enough to make a spreadsheet feel clever. Your real savings rate could be higher, lower, or already unnecessary. The useful revelation is that a pension does not shave a polite little amount from the standard 15% savings recommendation. It can fundamentally change the size, purpose, and deadline of your personal portfolio. The mechanism is reverse withdrawal math. If 4% of $750,000 is $30,000, and then $30,000 of dependable annual pension income replaces the income-producing function of $750,000 invested. At a 4.7% starting withdrawal rate, the equivalent is closer to $640,000. Put another way, each dependable dollar of annual pension income can replace roughly $21 to $25 of portfolio. That does not mean your pension has a cash value you can sell for that amount. It is not an actuarial lump sum valuation, and the 4% rule is not a law of physics. It is a translation between two income sources. One source produces a check from a pension plan. The other asks your investments to produce the same check while absorbing market risk, longevity risk, and the possibility that you retire during a terrible decade. Current retirement income research makes the distinction important. Morningstar's latest estimate for a new retiree seeking fixed inflation-adjusted withdrawals over 30 years, with a 90% probability of success, is a 3.9% starting rate. Flexible spending can support a higher initial withdrawal because you agree to take less after bad markets. So the useful planning range is not one sacred percentage. 4% gives us a conservative, understandable comparison, while the actual rate depends on your horizon, flexibility, allocation, and how much essential spending the pension already protects. Now, give two households the same $7,000 monthly lifestyle. Both expect $2,000 a month from Social Security. The household without a pension still needs $5,000 a month from investments, or $60,000 a year. At 4%, that requires $1,500,000. The other household receives a pension of $3,500 a month. Social Security and the pension cover $5,500 of the $7,000 lifestyle, leaving a gap of $1,500 a month. That is $18,000 a year, requiring $450,000 at 4%. Identical spending, identical Social Security, but a difference of $1,050,000 in the personal portfolio target. The household without the pension needs 3.3 times as much invested money to support the same lifestyle. If turning income streams into an actual retirement date is the problem you are trying to solve, I built a digital book called The Exit Code around that kind of math, including how guaranteed income changes withdrawal decisions. The link is in the description. By the way, clicking subscribe helps a lot, so thank you to everyone who does it. The portfolio difference flows directly into the contribution rate. Take the earlier $70,000 income target and assume no Social Security so we can isolate the pension. With no pension, investments must produce all $70,000. At 4%, the target is $1,750,000. A $60,000 pension leaves investments responsible for $10,000 a year, making the target $250,000. Starting from zero and earning 5% a year after inflation for 30 years, reaching the larger target requires contributions of about $26,300 a year. Reaching the smaller one requires about $3,800. On a $100,000 salary, that is approximately 26.3% versus 3.8%. The calculation is intentionally clean. Real life adds employee pension contributions, employer contributions, fees, taxes, uneven returns, and changes in salary. But those complications do not restore the generic 15% rule. They make the correct rate more personal. Your pension has already changed the destination, and your current investments determine how much road remains. That is where a visible account balance becomes useful again. Project the investments you already own to the date the permanent income gap begins. Compare that future value with the portfolio target created by the gap. Future contributions need to close only the difference between those two numbers. Suppose you are 45 with $100,000 invested. At 5% annual growth after inflation, that money reaches roughly $265,000 by age 65 without another contribution. If the pension leaves you with a $250,000 target, from our example, your existing account has already crossed the mathematical line. Under those assumptions, age 45 and $100,000 becomes a potential stop saving threshold. Stopping new retirement contributions is not the same as spending the account. It means the assets already accumulated may be capable of growing into their assigned future job. Money for emergencies, near-term purchases, healthcare, heirs, or any other goal remains separate. A change in returns, spending, or pension terms also changes the line. A threshold is permission to evaluate the next dollar, not permission to switch off your brain. I have multiple hundreds of thousands of dollars invested, and after more than 10 years running a business around accountants and fiscal lawyers, I have developed a mild allergy to percentages that arrive without a cash flow equation. Institutions like universal contribution rates because they are easy to automate and difficult to misinterpret on an enrollment screen. Your household does not retire on an enrollment screen. The apparent stop saving threshold also depends on the pension being vested and available when you need the income. If your pension begins at 65, having enough money for the permanent gap at 65 does not prove you can retire at 60. Those are different dates, and the 5-year space between them can be brutally expensive. Imagine the household spending $84,000 a year, retires at 60. Its $42,000 pension begins at 65. Social Security of $24,000 begins at 70. From 60 through 64, the portfolio may have to provide the entire $84,000. From 65 through 69, the pension reduces that annual burden to $42,000. From 70 onward, pension and Social Security reduce the permanent gap to $18,000. The $18,000 permanent gap still maps to $450,000 at 4%. That number remains valid for the phase it describes. It never included the earlier bridge. 5 years of $84,000 withdrawals followed by 5 years of $42,000 withdrawals create a separate temporary obligation. Ignoring it is how someone can be fully funded for age 70 and unable to leave work at 60. You do not calculate that bridge by multiplying 10 years of withdrawals and pretending markets and taxes take the decade off. Money removed early loses future growth. Pre-tax withdrawals may require larger gross distributions, and a bad market near retirement can magnify the cost. The clean way to model it is year by year, with each pension or Social Security start date reducing what the portfolio must supply. Retirement therefore behaves like an income staircase. Employment income ends on one landing. The pension begins on another. Social Security begins later if you delay it. Required minimum distributions eventually add taxable cash flow, even if your spending has not changed. One retirement number cannot describe every landing because the missing income gap changes height as you move through time. The same timing problem appears inside the pension itself when the benefit lacks a cost of living adjustment. A fixed pension of $4,000 a month will still display $4,000 on the deposit 20 years later. At 2% annual inflation, however, it will buy roughly what $2,700 buys today. About 1/3 of its purchasing power has disappeared, while the nominal check looks perfectly healthy. That erosion gradually transfers expenses back to your investments. If the pension covers housing, food, utilities, and healthcare at retirement, it may not cover the same basket at 85. Your portfolio then needs an inflation job in addition to funding the gap visible on day one. Counting the pension at full nominal value forever would understate that responsibility. A pension with a meaningful cost of living adjustment behaves differently because part of the purchasing power risk stays with the plan. Social Security also has annual cost of living adjustments under current law, although your personal benefit and claiming date still control the amount. The relevant comparison is never pension versus no pension in the abstract. It is a particular pension with a particular start age and inflation provision matched against expenses during each phase. That forces several facts out of the benefit statement. The promised amount means little without the age at which it begins. The start age means little if leaving employment changes the formula. The projected check cannot be treated as household income until you understand vesting. Its long-term purchasing power depends on the cost of living language. And if another person relies on the income, the survivor election changes both the check you receive and what remains after one spouse dies. A single life pension can show the highest monthly amount while creating the largest survivor gap. A joint and survivor option generally pays less while both spouses are alive because it may continue some portion after the pension holder dies. That reduction is not automatically a bad deal or a good one. It changes today's gap and the surviving spouse's future gap in opposite directions. Both phases belong in the same calculation. The word guaranteed also needs a surname. Most private sector defined benefit plans are insured by the Pension Benefit Guaranty Corporation, but protection is subject to legal limits and plan-specific rules. For a covered single-employer plan terminating in 2026, the maximum straight life guarantee at age 65 is $7,789.77 per month. The maximum is lower when benefits begin younger, and a survivor form can lower it further. That figure is a cap, not a promise that every benefit beneath it will be paid exactly as originally designed. Limits involving when benefits were earned, recent benefit increases, plan termination, and benefit form can matter. Multi-employer plans operate under a different insurance program with substantially lower guarantees. Government pension plans are not covered by the federal pension insurer at all. A public pension may have support from a government sponsor and taxing authority, but that is not the same mechanism as federal pension insurance. So the countable pension income depends on more than the benefit projection. A well-funded public or military pension, a covered single-employer private plan, and a multi-employer plan can all print the same monthly estimate while carrying different institutional risks. That does not require assuming disaster. It requires refusing to give every promise the same confidence level merely because the dollar signs match. Social Security deserves the same current document treatment. The estimated average monthly retirement benefit for January 2026 is $2,071, according to the Social Security Administration. That average is useful for context and useless as a substitute for your personal record. Your earnings history, claiming age, marital situation, and eligibility determine what actually closes your household's gap. Public workers also need to retire old assumptions about the windfall elimination provision and government pension offset. The Social Security Fairness Act, signed in January 2025, repealed both provisions for benefits payable from January 2024 onward. The old rules had reduced or eliminated benefits for more than 3.2 million people receiving pensions from work not covered by Social Security. That change can materially shrink the portfolio gap for an affected teacher, firefighter, police officer, federal worker, spouse, or survivor. It did not raise benefits for every public employee. Roughly 72% of state and local government workers were already in Social Security covered employment and were not affected by those offsets. The useful action is to obtain a current personal estimate rather than carrying an outdated reduction into a 20-year plan. Once dependable pension and Social Security income are matched against essential spending, the entire meaning of the portfolio changes. It is no longer responsible for impersonating your full paycheck. It becomes a bridge between benefit dates, an inflation engine for expenses that rise faster than fixed income, a reserve for shocks, and a source of spending you can delay when markets are hostile. That distinction changes risk in a way an account target alone cannot show. The household with $1,500,000 and almost no guaranteed floor may need to withdraw $60,000 during a market decline because groceries and housing do not care that stocks are down. The household with a pension-funded spending floor and $450,000 may be able to reduce travel, gifts, or renovations instead. Its balance is smaller, but less of the withdrawal is forced. Forced selling is the dangerous link in sequence of returns risk. Two retirees can earn the same average return over 30 years and receive very different outcomes because large losses occurred at different times. Losses early in retirement remove capital, while withdrawals prevent the account from fully participating in the recovery. If pension income covers necessities, fewer assets may have to leave the account at depressed prices, weakening that destructive chain. The pension therefore changes more than how much you accumulate. It changes which withdrawals are negotiable. That can support a more flexible spending policy for the portion of the portfolio assigned to optional expenses. It does not authorize one aggressive withdrawal rate for every pension holder. If the pension covers 30% of essential spending, you have a different capacity for flexibility than someone whose pension covers 100%. This is also why a withdrawal rate near 4% should be treated as a planning translation rather than a standing order. Morningstar's 3.9% estimate assumes fixed inflation-adjusted spending and a 30-year horizon. Dynamic systems can begin higher because spending adjusts after weak performance. But the price of that higher starting rate is variable cash flow. Guaranteed income makes that variability easier to tolerate, only to the extent that it protects expenses you cannot cut. Now, the brain problem changes sides. Undersaving happens when the pension is treated as a complete retirement plan. The bridge, inflation loss, survivor gap, and reserves remain unfunded. Oversaving happens when the pension is priced at zero and a household continues chasing a no pension target. One error risks running short later. The other spends healthy years, flexibility, and present consumption to accumulate money with no defined future job. More saving is not automatically harmful. It can finance an earlier exit, family support, larger gifts, a more resilient healthcare reserve, or a legacy. Those are valid jobs. But because responsible people max everything is not a job. The next saved dollar should either close an identified gap or purchase an option you genuinely value. Generic retirement advice tends to blend two separate questions. A contribution benchmark asks whether you are saving enough relative to salary. A retirement plan asks whether future income covers future spending through changing dates, taxes, and market conditions. The benchmark is administratively convenient. The plan is economically relevant. Mildly annoying, perhaps, but payroll software has never asked what you want your Tuesday mornings to look like at 62. By the way, if you value retirement analysis tied to actual household numbers, subscribing helps the channel reach more people like you. Thanks to everyone clicking it. Knowing the target and building a system around it are two different problems. That is why I built a digital book called The Exit Code, an analysis of 50 years of retirement data distilled into a mathematical framework for exiting the rat race. It explains the 4% trap and the dynamic withdrawal method that replaces a fixed autopilot with rules for strong and weak markets. It also shows how to turn projected income, spending, and the assets you already own into a specific exit date, instead of carrying maybe someday around for another decade. The framework is based on actual retirement data rather than motivational opinion, because optimism is a poor substitute for arithmetic when your paycheck stops. You can get it for less than a dinner out through the link in the description. The important connection here is that a pension changes the withdrawals your portfolio must survive. So the system managing those withdrawals must change with it. Taxes are the next reason a $30,000 pension does not always close $30,000 of spending dollar for dollar. Pension payments are generally taxable as ordinary income to the extent they were funded with pre-tax money. Some plans include an after-tax basis, which can make part of each payment non-taxable. Your benefit statement gives you a gross figure. Your lifestyle is paid with spendable dollars. Social Security adds another layer because other income can cause more of the benefit to become taxable. Under current federal rules, up to 85% of Social Security benefits can be included in taxable income when combined income exceeds the applicable thresholds. That does not mean an 85% tax rate. It means up to 85% of the benefit enters the tax calculation. A pension can help push more Social Security into that calculation. The cure is consistency. If desired retirement spending is after tax, compare it with after-tax pension, after-tax Social Security, and after-tax withdrawals. If you prefer to plan in gross income, Gross up the spending target and keep every source gross. Mixing a gross pension estimate with an after-tax lifestyle makes the gap appear smaller than the cash your bank account actually needs. Account type then affects how the remaining gap reaches you. Withdrawals from traditional retirement accounts are generally taxable. Qualified Roth withdrawals are generally tax-free. Taxable brokerage accounts can return basis and realize gains with different tax treatment. A universal withdrawal order ignores what the next income landing will do to your tax bracket. Suppose you retire at 60. The pension begins at 65, Social Security begins at 70, and required distributions arrive later. The years immediately after work may contain unusually low taxable income. Pulling some money from a traditional account during that window, or evaluating a Roth conversion, can deliberately recognize income before pension and Social Security stack on top of it. The conversion creates a tax bill now, so the value depends on present and future rates, Medicare-related thresholds, state taxes, heirs, and the cash available to pay that bill. There's no account order slogan that solves every household. Spending from taxable assets may preserve tax-deferred growth, but waste a low-income conversion window. Emptying traditional accounts too quickly can create a large current tax bill. Preserving Roth assets can buy future flexibility, yet refusing to use them during a high tax year defeats part of their purpose. The correct order is the one that controls lifetime taxes while still funding the staircase. Required minimum distributions alter that control. For many people reaching the applicable age now, distributions from traditional retirement accounts generally begin at 73. Under current law, the applicable age becomes 75 for people who attain age 74 after 2032. Roth individual retirement accounts and designated Roth workplace accounts are not subject to lifetime required distributions for the original owner under current rules. An oversized pre-tax balance can therefore manufacture taxable income later, whether you need the spending or not. The withdrawal is required, spending it is not. You can reinvest what remains after tax, but the tax event has already occurred. A pension holder who keeps contributing at a no pension rate may arrive at 73 with pension income, Social Security, and mandatory distributions colliding in the same tax years. That does not prove you should stop saving or favor one account automatically. It proves that the type of saving matters after the spending target is funded. A contribution that earns a deduction during a high-income working year can still be valuable. A Roth contribution may protect a future tax flexibility pool. A taxable account may be useful for a bridge before retirement plan access becomes convenient. The pension changes the trade-off because it occupies future tax brackets before the portfolio sends out a dollar. Return to the household spending $7,000 a month. Its pension is $3,500. Social Security is $2,000, and the permanent monthly gap is $1,500. At 4%, $450,000 funds that permanent gap before taxes. That remains the base target, not the finished target. If retirement and pension both begin at 65 while Social Security begins at 70, the 5 years before Social Security contain a larger gap. Spending is $84,000 a year. The pension provides $42,000, leaving $42,000 for the portfolio during those bridge years. Once Social Security contributes $24,000 annually, the portfolio burden drops to $18,000. The temporary $24,000 difference belongs in a bridge calculation rather than being capitalized forever. If retirement begins at 60 while the pension waits until 65, another temporary layer appears. The portfolio carries the full $84,000 spending target until the pension starts. That 5-year cost can exceed the permanent $450,000 target because early retirement asks the portfolio to perform a much larger job before guaranteed income arrives. Then, assign inflation responsibility. If the $42,000 pension has no cost of living adjustment, do not pretend it permanently covers the same expenses. You can model the uncovered amount growing over time. Assign inflation-sensitive expenses to the portfolio from the beginning, or hold a separate resilience margin. Each method can work if it recognizes the transfer of purchasing power risk. Sponsor reliability can alter the countable pension amount or the reserve behind it. Survivor terms alter household income after a death. Healthcare before Medicare can increase the bridge. A mortgage payoff can reduce later spending. Travel may be heavier early in retirement and lower later. These are not decorative assumptions. Each one changes the gap's size, duration, or certainty. Now compare the combined working target with the future value of current investments. The working target contains the permanent gap, the temporary bridges, and the specific resilience obligations assigned to the portfolio. If the existing portfolio is projected to exceed that target at the desired retirement date, the required new contribution is 0 for that goal. If it falls short, future saving needs to close the shortfall and nothing more. Take the clean $250,000 target again. At 45, $100,000 growing at 5% after inflation reaches about $265,000 at 65. Under the stated assumptions, continuing to save for the permanent gap is unnecessary. But if you want to retire at 60 while the pension begins at 65, the bridge reopens the shortfall. Your stop saving date and your retirement date separate because the portfolio acquires a new assignment. A lower return assumption can do the same thing. At 3% real growth, $100,000 becomes roughly $181,000 after 20 years, leaving about $69,000 to fund. Higher retirement spending widens the permanent gap. A smaller pension widens it again. A cost of living adjustment can reduce the inflation reserve. The equation responds to reality instead of protecting a favorite percentage. The annual savings rate comes last. Start with the working target at the date the money is needed. Subtract the projected value of current investments at that date. The remaining shortfall is what future contributions must accumulate. Backsolve those contributions across the years available using a return assumption you can defend. Divide the required annual contribution by salary only if you want to express the result as a savings rate. That rate might be 3.8%, 12%, 26%, or 0. 0 does not mean the pension made investing irrelevant. It means previous investing and future growth may already cover every portfolio job you have assigned. 26% does not mean you failed. It may mean you are funding an early bridge, a larger lifestyle, or a benefit that starts much later than retirement. You can also convert the equation into an earliest exit age. Project your current portfolio 1 year forward. Measure the bridge created by leaving work at that age and compare the result with the remaining income gaps. Repeat for the next year. Eventually, the account crosses from funding only the permanent gap to funding the bridge as well. That crossing is the age when the pension may let you stop working years earlier, even if you stopped contributing before then. The behavior around that threshold matters more than squeezing another decimal from the return assumption. Some pension holders discount an invisible benefit because there is no seven-figure balance in an app. Others treat the promised check as complete protection because it arrives automatically. Visibility drives confidence, even when visibility has little relationship to economic value. The institutions involved reinforce that bias without needing a conspiracy. Workplace systems display contribution percentages. Account providers display balances. Pension statements display future monthly income. And the tax code rewards or penalizes different dates. Each system measures its own piece because that is what its incentives and architecture were built to do. Your job is to price the pieces together. Lazy investing built more fortune than crypto memes. The deeper advantage is behavioral. When every dollar has an assigned job, you are less likely to panic into undersaving or compete your way into unnecessary oversaving. Save enough to close the projected missing income gap, including the bridge, inflation, reliability, survivor, and tax responsibilities your pension does not cover. Pricing an invisible pension at 0 wastes years. Pricing it as an entire retirement plan leaves the dangerous gaps exposed.